Okay, we'll go ahead and get started. Again, my name is Alex Oliver. I'm a financial advisor at First National Corporation, and we're running our financial bootcamp series again this year with Schwartz & Schwartz Accountants. So I appreciate you joining us today on your lunch hour. This is going to be our first of 4 webinars this season in 2020, and I hope to give you a little bit of perspective today on the overall economy and give you an idea as to what might be happening in stock markets this year. We'll go over a bunch of different data from 2019 just to give you a sense as to where we stand. So I've got plenty of charts, interesting graphics to give you some perspective on how the markets look. And then we'll talk a little bit about what's going on today. We've had a lot happen already here in January. Today is January 29th. So we had our Iran crisis a few weeks ago. Now we're going through the coronavirus in China. So I've got a few thoughts on those kinds of things from an overall economy perspective that I'm hoping to share with you today. Just to give you a little bit of background on us, my company, First National Corporation, we are a registered investment advisor. Just simply means that we are an independent company. While we custody assets at, say, Schwab or Fidelity, have 401k plans at Mass Mutual, John Hancock, what have you, not affiliated with any of those companies. We're a completely independent firm. And we've been doing so for over 30 years now. Currently work with a little over 400 households and 50 retirement plans, serving as a fiduciary on the clients that we work with. So at our core, we are making investment decisions on our clients' behalf, whether that's through IRAs, Roth IRAs, health savings accounts, their employers' 401ks, etc., and acting in the interests of our clients. So really getting to know their situation, their financial plan, putting a financial plan in place, and then again, allocating a financial plan and investments to fit those needs. Again, I mentioned earlier, we do this financial bootcamp series with Schwartz & Schwartz every year. So this year, again, today we're doing the stock market review, and there will be recording of this. So if you've registered for this today, within the next 24 to 48 hours, you'll get a link to YouTube if you want to go back and re-listen to that, if for some reason you can't stay on the call all for the full hour today. Coming up next month, we're going to go over health savings accounts, the new and improved 401k plan. It's a relatively new account, relatively by, say, 15 years, but has become much more used as we start to use our own healthcare plans, or at least take the onus on ourselves to track our healthcare expenses. So health savings accounts are a major recommendation in my financial plan. So I want to make sure I dive deep on those next month, and hopefully you'll join us for that. We're going to go over simple IRAs, 401ks, profit sharing plans, and cash balance plans in March. So if you're a small business owner and you've heard some of these terms, I'll give you an idea as to the analysis that I go through to figure out what kinds of retirement plans a specific practice might want to put in place. And then finally in April, we're going to have How to Fire Part 2. FIRE is becoming financially independent and retiring early. And so Part 2 is going to talk about distribution strategies for an early retiree, which certainly has a lot of tax consequences that an accountant like Schwartz & Schwartz would be helping you out with. So I would encourage you all to register for these events. You would go to schwartzaccountants.com/events/bootcamp, because again, if you can't make one of these times, a Wednesday or a Friday at noon, for example, you will get emailed a YouTube link shortly after the recording where you can watch it at your own speed. You can watch me at 1.5 speed or 2 times speed to really whip through that. So I would encourage you checking that out. At that same page, you can see our last webinars over the last couple of years that we've recorded and posted here. So again, these are all YouTube links. As I mentioned, we're doing Part 2 of the FIRE series. Part 1 last year was actually our most popular webinar. Well over 100 people registered for that YouTube event. And I can only see why. I guess we're all trying to retire as early as possible. And there's a lot of investment and tax strategies that I discussed there. If you've got student loans, if you're wondering about your 401k, if you're getting close to retirement, if you're wondering about Social Security, it's just a really broad array of topics that we discuss here. So again, encourage you to check that out. Go ahead and visit the YouTube links and hopefully get some more information there. So as always, I want to make sure I lead with this disclosure that everything I say today is just my own opinion based on everything that I read in my full-time job here. If I'm reading Barron's or Wall Street Journal or JP Morgan's Guide to the Markets data, this is all just sort of a little consolidation summary of what I see. And I wouldn't necessarily take anything I say today as investment advice or a strategy. If I say that I'm liking small cap stocks, I certainly wouldn't encourage you to go out and buy those just based off what I'm talking about today. These are just my simple thoughts to give you an idea as to what's happening here in 2020. So you may have seen on that last list that last year, just about this time, we did a webinar and had done an economic review for 2019, or actually really 2018 and leading into 2019. And so before coming to today's webinar, I went and rewatched that recording just to give you an idea as to where we stood 1 year ago. We had just been coming off the December 2018 drop. So there was a massive drop in the markets due to the trade war with China. You may remember we had a government shutdown during that time. So even though we had an overall fairly good year in 2018, we lost it all in December, and the S&P 500 ended up being down about 6%. So at that time, valuations on the S&P 500, this is just a price divided by earnings. So the price of the stock market divided by what they were earning at the time was about 14.4, which is cheaper than the 16 average. So we went into 2018 thinking, okay, stocks actually look pretty good. In fact, corporate earnings in 2018 were up 28%, but the S&P 500 was down 6%. So a little bit of interesting dichotomy there. In 2018, GDP had grown by 2.9%, which was actually above the 40-year average for GDP growth in the United States. So again, really accelerating growth there. Tax reform in December of 2017 really helped with that. Primarily the corporate tax rate cut from 35 down to 21%. And so we saw corporations with a lot more money on hand, a lot of stock buybacks, which really drove the market. But again, saw a big fall in December. We had a pretty humming economy during that time. In December 2018, 300,000 jobs were added. And, despite all that, there's always a concern about inflation. And so the Federal Reserve in January of 2019 was expected to raise interest rates in 2019. So what actually ended up happening, we had a great year in the markets. Everybody knows that right now. The S&P 500 went up 29%. So that doesn't happen very often. We now sit at valuations at 18.2. So again, just to recap, it was 14.4 beginning 2019. Historically, the 25-year average is 16. Now we're at 18.2. So a little bit more expensive than we'd like to be. In 2019, corporate earnings actually dipped from 2018. They were down 4% from where they were. So completely opposite. The corporate earnings started to go down, but the stock market went way up. And there's a lot of metrics that would basically tell you now that we're exactly where we should be. I'm going to go into all those reasons why. But essentially now we've gotten to a place where the market is, hypothetically fairly valued. And a lot of economists are calling for a slow growth year in 2020. Again, I'm going to get into a lot of the reasons why that is. So we'll see where we go. Real GDP is likely going to come in at about 2.1%. So again, slow growth here compared to 2.9 in 2018. In December, we had about 145,000 jobs added to the economy. Unemployment now at 3.5%. So again, still growing, still adding jobs, just at a slower rate. And instead of raising rates in 2019, as was expected, the Federal Reserve actually cut interest rates twice. And so, that's quite surprising. From my perspective, it makes sense to some degree because if you remember the year, there was a lot of uncertainty with the China trade deal. Inflation is still very low, and that's always what we worry about when money is very cheap to borrow, that we're all, either as consumers, home buyers, and corporations, if we're all able to borrow money at a very low rate, we might have a higher rate of inflation, but we just haven't seen that happen yet. And so to sort of buff up against a recession issue coming from a China trade war or whatnot, the Federal Reserve elected to cut interest rates. And so now we're well below 2% on those now. And I'm sure you've seen that in your savings and checking account where you're getting no interest at all. And so now, just to give you a 2-year perspective, the S&P 500 through yesterday is actually up about 17.48%. So about 8.74 on an annualized basis. So even though, again, last year we were up this big 29% number, When you put it into perspective over a 2-year figure, this is actually in line with historical stock market returns. We typically say that we can expect an 8 to 10% annualized return in the stock market. Over the last 50 years, the average S&P 500 annualized rate of return is 10%. So again, quite normalized at this point if we look over that perspective. But it certainly doesn't feel like that, especially when you look at a chart like this. This is the S&P 500 over the last 20 years or so. This goes back to the technology bubble in the 98, 99, 2000 range. And then we had our slight little recession in 01, 02. We then rose through the housing market issues and then had our housing market crash in 2008. And then for the most part, it's been off to the races. We had a down year in 2015. And again, as I'm referring to right here, we had a 6% drop in 2018. But again, almost all up from there on out. But as I mentioned, this now puts us at a relatively expensive valuation. So price divided by earnings, again, the price that we're paying for stocks divided by how much money they're actually earning, on average over the last 25 years is 16.28. Again, last year, this is about where we were in January of 2018. And here we are right now, 18.18. So it's just something to keep in mind because back in the 99, 2000 level, this is our tech bubble. So we could see that at a 24x valuation, this is historically very expensive. And that could be one of the reasons why we had our crash in 01 and 02. You can remember a lot of different tech companies that just weren't earning any money, having their issues, which frankly is familiar with 2019. I mean, we saw a whole issue with a lot of IPOs. Uber, Lyft, all went down after they had their initial public offering. We all remember what happened with WeWork in 2019, where their private valuation was upwards of $47 billion, and then they couldn't even IPO for $10 billion. So things like that, on the one hand, make you a little concerned that there are a lot of companies out there that just aren't earning any money but still having high valuations. On the other hand, it does seem like investors have at least come to grips with those kinds of situations and made sure to punish those companies if they do not have clear paths to profitability. So, do I look at this as concerning? Actually, again, as I mentioned before, I think about this as quite about right. Because when you think about it from a broad perspective and you think about, well, where do I put my money? Where am I going to put this right now? Again, it's probably not going to be a checking account or a savings account or a certificate of deposit or a 10-year treasury, because these are all yielding you well below 2%. And inflation right now is running you at about 2%. So you would actually, on a real basis, be losing money by putting money into those areas. Bonds, same thing, very low yield rates. So, from that perspective, it's like, well, I guess I'm going to put my money into businesses that are, again, very profitable, getting very profitable policies from our administration right now. And so I think it's reasonable to say that valuations are going to be a little bit higher these days. Again, keeping that in mind, though, this just puts it into perspective that at a valuation of 18, which again, last year we were about 14, if you can follow my mouse here, this is telling us what our forward rate subsequent returns have been historically. So again, as you can imagine, over a cheaper valuation, we've typically had higher rates of return. This is the 1-year return, which does not have a great correlation rate. So these plots are scattered all over the place. However, the 5-year annualized returns do give us a little bit of a better perspective. And so again, last year, we were right over here, about 14, which maybe gave you a 10 to 15% subsequent 5-year annualized return that you might expect. Now we're here. So now we're looking at maybe a 5% rate of return over the next 5 years. So again, that's why I say the consensus that a lot of economists say is that they're not expecting a recession in 2020. We're going to talk about some reasons why we don't think there are going to be any major shocks to the system, with some caveats, but we don't think that it's going to happen. But we do expect slower growth moving forward. Okay. I do like this chart too. This puts into perspective, all the different kinds of stocks out there. So we have to remember that there are large companies out there, your Apples, your Facebooks, your Googles or Alphabets, if you will. There are mid-sized companies and there are small companies. Here in Boston, we have Wayfair, which is actually considered a small company, still kind of a relative in these terms, sort of startup phase of a business. And then we also have what are called value stocks, which might be dividend payers, your Coca-Colas, if you will. And then we have growth companies, which might be your Apples, your Facebooks, your Netflix, and whatnot. And in 2019, essentially all categories had quite the level of returns. Large cap growth was our biggest category, again at 36%. Apple played a big part of that. I believe Apple was up 86% last year, if you can believe that. So, no matter where you invested last year, you saw pretty significant growth. And frankly, since March of 2009, large cap growth has really been the bellwether of the S&P 500. Those companies have really carried the weight here. We're going to get into Apple a little bit later on and these kinds of companies, but I just want to show you how phenomenal that is. I showed this chart last year too, because again, I keep going back to valuations and trying to figure out where we might be able to find stocks at a bargain price. But right now, there's not a whole lot of area for that. We've already talked about price to earnings being high relative to historical terms. But even if you break it down into large cap value, large cap blend, large cap growth, these are all trading above their 20-year average price to earnings ratio, except for the small cap value space. So if you're a real value investor and you believe in that story, the valuations would actually tell you that that might be where you want to allocate a little bit more of your money. The caveat being that I could have told you that exact same story 1 year ago, and large cap and small cap growth ended up outpacing small value. So you have to take that all with a little bit of a grain of salt. So, stock markets go up when companies earn money. We have to remember that. This isn't just a complete gambling game necessarily. Corporate profits have been rising for the most part, and this gives you a little bit of an idea as to how that's been trending over time. So this is, essentially directly correlated with the market. But what you can see here in the third quarter of 2019 is a drop in earnings as compared to the third quarter in 2018. So a little bit of a concern there. But right now, the S&P consensus analysts actually say that in 2020, we will continue to have a rise in profits. Now, that's not always going to be something that we can really rely on because, again, if you go watch my webinar 1 year ago, I would have told you that the consensus estimate, was for 9% growth, but we ended up being down about 4%. So again, take everything here with a little bit of a grain of salt. But nevertheless, it is true that the S&P 500 companies, their profit margin is rising, a little bit dipped here, as compared to say 2017, 2018, but historically at a elevated level. So again, really supports that story that if I'm going to be putting money somewhere, it's probably going to be in stocks as opposed to bonds if they're going to have these elevated profit margins, which again is likely a direct result to tax reform in 2017. So, that's the United States story. I think there's a lot of good reasons to still think that United States equities have some room to run. We're going to continue to talk about that as this webinar goes on, but I do want to continue to acknowledge the international story, which is quite interesting. If you look at the valuations of the United States and think that they're relatively expensive, again, you can kind of see here just the S&P 500 compared to their 20-year average quite high. This is what's called the All-Country World Index. So this is trying to capture the entire world outside of the United States, which if you can believe this or not, the United States actually makes up about 56% of the overall world market size. So we're only talking about 44% just in the rest of the world. And right now, the rest of the world has not really gotten a whole lot of love. Again, you can kind of look over since 2009, quite a rise in U.S. equities with a, relatively stagnant international market. And why has that happened? We had our Greek crisis back in 2012. We've obviously had the UK Brexit issue that's been going on for 3 years and is finally resolving itself. Obviously issues with trade wars, whether that's the United States with Canada and Mexico, which we just got a new deal signed on, or whether that's China or even with Europe. So a lot of issues with these kinds of countries that hopefully we can start to look at the international story and maybe get back to the 2004, 2005, 2006 levels where international markets actually outpaced United States markets. But again, I could have told you that 1 year ago, and unfortunately, international markets did not keep pace with the United States. So it's just something to keep our eye on. And this goes back again into valuations from a perspective of the United States. These are emerging markets. So Brazil, Russia, India, and China, valuations have dropped here. Japan has dropped, and then Europe has stayed pretty stagnant, while again, the United States, earnings have been quite spectacular. And then broken down one more way is just showing you their current price to earnings ratios compared to their historical rates. So again, pretty high for the United States. Developed markets just a little bit high. Europe right on their historical rate. So another one that we might consider with low interest rates. I mean, Europe is quite a story because in some countries over there, we still have negative interest rates where it actually costs you money to put your money into your checking account. So again, really a big push to try and invest in corporations, but so far that just hasn't happened over there. Japan, this number is always off because they had some pretty significant gains for quite some time in the last 25 years. It's actually about 20 to 25 years ago, but then a massive drop. They have some major demographic issues in Japan, so that's why those valuations have been much lower than that historical figure. And then emerging markets, where we see some lower valuations and some concerns around, again, China and Russia for a myriad of reasons. Okay. So I'm going to go back and forth here, kind of give you the pros and the cons of what I'm looking at in the market, again, to kind of maybe allay some concerns of a major recession, because for investors that might be relatively young, maybe age 30, age 40, the only thing you may know is that 2008 recession, when we had a drop of well over 50% in the S&P 500, which is completely uncommon. That and the Great Depression in the 20s are once in a lifetime events. And usually the way this works is a recession happens and markets may dip, say 5 to 10%, not this massive 50% figure. But in any case, when we're making financial plans, we need to think about that, because when you have a massive drop in equities and you're 64 years old, that might literally change your retirement date by 5 to 7 years in order to wait for that market recovery to come. So we do want to make sure we watch for those kinds of things. And one sort of encouraging area here, I mentioned that price to earnings probably aren't high enough to cause a major recession, but back in 2007 and 2008, household debt was actually really one of the reasons, but one of the bigger reasons why we had an issue. And this is telling you actually a very encouraging story, where household debt as a percentage of personal income is actually at its lowest level, at least on this chart, in the last 30 or 40 years. So just to give you an idea here, in the fourth quarter of 2007, household debt, which makes up your mortgage payment, your auto payments, your student loans, etc., relatively 13.2% of income at that time, and then now it's at 9.7%. So two sides of the coin here. Debt is relatively lower, but incomes have also risen. Wage growth last year was in about the 3% range. We're finally starting to see some wage growth from Americans here. So if we had a major issue with job losses, it's at least conceivable to think that people wouldn't necessarily have to have their homes foreclosed on, because the debt ratio is a little bit lower. Meanwhile, household net worth has risen, fantastically over the last 10 years or so. I did this calculation before the webinar, and it comes out to a little over 4% growth from the peak of 2007, where again, inflation has been relatively about 2%. So household net worth, again, putting consumers in the United States in a very good position to withstand a shock to the system if that were to occur. Okay, so that's some of the good news. I'm going to now hit you with a little bit of bad news, because there are definitely some demographic concerns that may not show themselves immediately in 2020, but they're going to be part of the slow growth story that we see over the next 10 years. Because what's happening, and what's been happening for the last 1 or 2 years, is that the amount of job openings that companies have offered are higher than the actual amount of people that are seeking out full-time employment, or at least are qualified for the position, which is quite rare. So, our unemployment right now is 3.5%. It's probably at its lowest going to get to a 3.1 or a 3.2% rate. And then at the end of the day, high-tech companies just aren't, frankly, going to be able to find the people to fill those positions. And you can see here some of the demographic concerns that we're kind of looking at. This goes over native-born Americans versus immigrants to the United States. And you can see that these numbers are dropping pretty substantially in both categories. So again, the consensus forecast here is only for 0.2% population growth. This goes to that whole notion that for every one or for every couple in the United States, they're only birthing 1.8 babies right now. So that alone obviously wouldn't be able to keep population in the United States. And obviously immigration policies have really restricted a lot of, say, H-1B visa applications or green card offerings. And so we just don't currently have a working population to fill those positions, which is going to slow the growth of a lot of those companies. So that would just be something to keep in mind as we go on here. And right now, productivity, output per worker is also dropping. So if we have a drop in workers and a drop in productivity, GDP growth is going to slow or go down. So there has to be some fundamental changes here. Again, these are things that are trends that happened over decades, not necessarily year to year, but it's just something to keep an eye on. On the other side, again, this is completely unrelated, but just a sort of bit of good news that I like to highlight here, because back in, say the days of Hurricane Katrina or, any other, massive event, oil prices were a big part of the U.S. economy. And if the prices of a barrel of oil went way up, that meant the price of goods that we were buying from other countries went way up. The price to ship these goods went way up. And so we really don't want to see massive spikes in oil prices. And, the United States has really made a committed policy, if you will, over the last 10 or 15 years to really get away from importing foreign oil and being set to whatever happens to those areas. And these charts really show what's happening here. Last year, I showed this chart, and oil consumption in the United States was growing at about 6.6% on a 5-year basis. Now we're looking at a 5.4%. So we're still growing in our oil consumption, but that amount is slowing down. Obviously as global warming becomes a bigger issue that we're on the forefront of, and we start using more solar and wind, you would expect this consumption figure to go down. The figure in China has also gone down. The figure globally has also gone down. So that's good. And then in the meantime, the United States actual production of oil has risen substantially. So 1 year ago when I did this webinar, the growth since 2016 was about 29.5%. Now it's at 42.9%. I mean, just look at these numbers on a year-to-year basis. These are the news stories that you see from people drilling in, say, North Dakota. These are the new technologies that you've seen where, again, we can drill both horizontally and vertically that have really changed the face of this. OPEC, which refers to a conglomerate of countries that really try to work in conjunction with each other as to how much oil they'll produce and what they're going to sell it at. In 2019, they basically made a deal to sell less oil so that way they could keep the price of oil up. And so their production has dropped substantially. Last year it was down 0.2%. Now it's down 8.3%. Meanwhile, Russia, who's not part of OPEC, they actually produce at a similar level as they have in the past, because over 50% of their economy is based on oil. So they have to keep pumping it out no matter what the price is. So this is a long way of saying that for the most part, we see a pretty good stable market here. When we had the crisis in Iran a couple of weeks ago, we had a short spike in oil, which I think got us up to a little over $64 a barrel. Now we're actually in the mid 50s. And so pretty consistent over the last few years, which is quite different from the massive jumps that we had seen over the last decade or so. So a little bit of good news there that we're seeing some stability in the oil markets, which overall will help the United States economy in particular. Okay, now we get to a little bit more of the bad news. We actually just had a report from the Congressional Budget Office yesterday talking about the amount of debt that the United States is taking on. Unfortunately, the tax cuts that were put in 2017 were meant to spur growth, were meant to spur repatriation of assets from abroad back to the United States. And unfortunately, there were no other cuts in spending made. And now I think we're adding $1 trillion a year to the federal debt, which is expected to happen in perpetuity. So in a vacuum, that sounds bad, but we have to put that into perspective, because the whole point of cutting taxes and trying to spur growth is to spur GDP growth. And if the economy as a whole is growing, we can handle a much higher percentage of debt. But again, unfortunately, what's happening here is that the percentage of debt compared to GDP is rising. So again, last year, if you had attended my webinar, I would have told you that the debt to GDP ratio was 77.9%. Now it's at 79.5%. That was as of January 1, but the Congressional Budget Office report from yesterday actually puts that at about 81%. So you can see the graph here. That has not occurred since we were back in World War II and funding a war. So that, really is a concern to some degree. If interest rates rise, that means that we have a lot of interest to pay to other countries that are holding our debt. Right now, the net interest debt is a very small component of our total spending budget. So, not an issue to worry about today, but is something to keep in mind as we move forward. I like to talk to my clients about the year 2025 because that tax bill we had in 2017 sunsets or basically expires in 2025. So it's very reasonable to believe that tax rates are going to rise sometime in this decade. And we've put some issues out about potentially making more Roth contributions, making Roth conversions while you're in retirement, knowing that the federal debt is accumulating, knowing that interest rates are probably going, tax rates are probably going to go up in the future. And this chart really hits that home that by the end of the decade, debt to GDP is going to be about 95%. And if interest rates rise over that time, it's going to be a big problem. We're going to have to cut spending. Obviously, Social Security and Medicare are big parts of that. So potentially raising the retirement age is one thing to consider, but taxes are also probably going to figure into that. Okay, a few other metrics that I want to make sure I again make you aware of. Last year, again, if you had attended my webinar, we were about right here. So forget about this part for a second. We were about right here in this Purchasing Managers Index chart. The Purchasing Managers Index basically is a survey of several companies trying to figure out, are you actually adding new supplies and trying to expand your business? And basically a reading of over 50 would indicate that we're going to have acceleration of the sector. Okay, so we want to see this figure over 50. We would then kind of use this as potentially a leading indicator to believe that we'll have further growth in the economy, which again, 1 year ago, we were in pretty good shape. A lot of green, definitely some yellow, but a lot of green here where a lot of these numbers were over 50. Let's just see, I have the figure from last year was 51.5 globally, and now it's at 50.1. So technically still indicates acceleration, but we're getting ready to drop below that. And you can see a lot of yellows in here and definitely some reds. You can see Germany is actually the red portion of this here. Germany, interestingly enough, is a major exporter. I mean, we're all very familiar with the automobiles that come out of Germany. Maybe some of you drive a German-made automobile, and this is where the global economy is really tied in together. So last year we had a trade war with China, and Germany really got the brunt of that because with China's economy slowing, which we're going to talk about in a couple of slides, they were importing less goods and specifically importing less luxury goods, which really hit Germany hard. And so I can't remember if they technically were defined as being in a recession. I don't believe they were, but they were, on the edge of that. Very low GDP growth, well under 1%, and it's certainly a concern as we go into 2020, where you can see their PMI was 44.1 in November, 43.7 in December. Obviously, Germany is a very big part of the European area, so we have to certainly monitor that. So definitely some areas of concern here where, again, we can at the very least likely say that globally we're going to have a slow growth year. Okay, and so just my final chart, and then we'll get into a few other points as we look ahead. This is going over global trade. So with the trade war coming into effect, global trade has come down. Again, I can tell you that last year, this number was down 0.4%, and now it's down about 1.4%. So, there's a lot of news around these things because there's a lot of uncertainty around it. And over here, what we show is that the exports as a share of GDP, a point that I made last year is that the United States exports as a share of GDP are only 8%, while China's is 19%. So when you start levying all these tariffs on importing goods, the United States really, isn't going to be affected by that too much. Those tariffs have already existed in the past. This kind of just shows you that. But the United States has really stacked, a bunch of tariffs, and specifically on China these days. And it makes it very hard for China to export goods to a United States buyer, which is obviously going to slow their growth. So, we just had phase one signed a month ago. Phase two has already been said is going to be put off at least probably until after the election. And now, China has a coronavirus, which we're going to talk about, which is a whole different can of worms. So we'll have to kind of watch global trade as a whole. I mean, from an economist perspective, from a business perspective, we want free trade. We want businesses to be able to buy the goods where they're made the best, at a reasonable price. But when you put in tariffs, that starts to change the dynamics there. And companies that aren't well exposed to other regions can really be affected by this. So Apple is a great example. I don't know if anybody has followed Apple. A lot of you probably have Apple in your portfolios. But last night they reported their earnings, and again, they were up 86% last year. I think they're had a great earnings report, and now are up a few percent today due to that. And one thing they talk about specifically is regarding coronavirus, that they really don't have a lot of operations in China. They've really spread their operations to several countries, whether that might be Vietnam or Malaysia or whatnot, just so that if something happens and a tariff gets imposed, they can kind of diversify their subset of suppliers. Whereas a smaller company really can't afford to do that. They may have just one supplier that they're working on. And so again, if a tariff comes into place, that small company is going to get hit hard. So again, that's why you might see the large growth space, again, do well in 2019 and maybe continue to do well if or at least outpace small cap companies if the trade war continues. Okay. So, sort of in summary here, as we look ahead to 2020, I look at all these things, try to, sum it up and say, what are my initial thoughts? Keep in mind that so far in 2020, the S&P 500 as of today is up 4%. So carrying a lot of momentum into 2020. And there's actually some other historical data that shows that stock markets that rise over 20%, you would think that the next year might be their down year, but in fact, they actually typically still have a pretty strong year due to that momentum. So, as I look at some of these metrics, I don't see any major shocking areas, either high valuations or, again, oil prices coming into play. I think we are in a pretty stable place, notwithstanding any other world events that may happen, which we're going to get into in a second. But I think there's a pretty good case that we might have, again, slow growth in 2020, which is at least a positive. Of course, caveat that with the presidential election that's coming up later this year. Currently, if you just went to Las Vegas and we're going to put a bet on who was going to win, Las Vegas would tell you that we would predict that Donald Trump would continue to, serve in the White House another 4 years. Again, historically, presidents don't typically get ousted after their first 4 years. Most presidents are at least given a second chance to implement their agenda. Obviously, this presidency is much different than others in the past, but if that were to continue, we would probably see a pretty calm state of the markets. But, with a Bernie Sanders or an Elizabeth Warren at a very progressive agenda, would certainly change things. I couldn't tell you if it would be better or worse. I would just say that it might add some volatility as the year went on. Okay. Interest rates and inflation, I would at least expect them to stay pretty steady. I mean, right now, the Federal Open Market Committee does not, they released today that they're not going to raise interest rates. They don't plan to raise interest rates until maybe the end of 2020. So they're being very careful here. I think they've kind of assessed the landscape and said there's a lot of uncertainty with global trade. Inflation, again, is very low. There's no reason to raise interest rates. As time goes on, it's one of their biggest tools to fight against a recession. I mean, when we had our recession, they were able to cut interest rates down to zero, down from, say, 4 or 5% very quickly, and that helped stimulate the economy. Right now, they really wouldn't be able to do that if something happened because, again, we're only at 1.5%. So there's not much room there. They would like to raise interest rates, but right now they can't. So I think they're going to be staying pretty steady there. GDP, I think, is going to be, again, a slow growing year at about 2% with minimal recession risks. Keep in mind that a recession is defined as 2 consecutive quarters of negative GDP growth. So I just don't see that happening. There's just too much momentum from 2019's figures to let that occur. But the big caveat to everything I say here is what's happening in China today. So, I'm going to just spend 2 minutes on that. I don't have any charts on this, but, right now, coronavirus, this is January 29th, coronavirus is going around China. Currently, 132 people have died. Over 6,000 cases have been confirmed. Only 5 confirmed cases in the United States, and no deaths in the United States as of right now. But when you look at China, the country as a whole is essentially on lockdown. They just had Lunar New Year recently, which is a time when Chinese migrate from city to city, which is why this is such a big concern. The coronavirus is one that you could possess, not show any symptoms, and still spread to other people. And so when now we're migrating 400 million people across the country, it's a very big cause for concern because we don't currently have, a vaccination for it. We don't have a cure. We don't know, how fast it might progress. So, essentially China has taken the state to say, okay, let's actually extend the Lunar New Year. Instead of being a 3-day holiday, they've now made it 5-day holiday. They're really not encouraging people to actually leave their houses at all. I have some in-laws that live in China right now, and they're just bored out of their minds staying in their house to let this sort of pass, hopefully, as time goes on. So, time will tell how large of an effect this is. But when you look at a big global perspective from the economy's perspective, China's GDP growth has been slowing. Primarily, it has been blamed on the trade war, and was about 6% at the end of 2019. They came out, the Chinese government came out yesterday and said that with this essential lockdown due to the coronavirus, it's very possible that GDP growth for the first quarter of 2020 is going to fall below 5%, which again is historically very low. You got to imagine, again, people are locked down in their houses. They're not going to work. They're not going to do their jobs. So China in itself probably going to see very slow growth in 2020. But China is the world's second largest economy. There are a lot of United States companies that still import an extreme amount of goods from China. So if people are not going to work to produce those goods and send them to the producers, the people that are buying from them, you're going to see that affect growth as a whole. So that's a big thing to keep in mind. I'll be interested to watch this webinar 1 year from today and see what actually happened. I can tell you that right now, the stock market analysts are really not considering this to be a big deal. Again, as I told you, the S&P 500 is up today. So they would expect this to pass as time goes on. But if it becomes something that they can't get under control very quickly, you're going to see some slower growth, and everything I talked about today is going to be affected pretty substantially. So just an interesting story to keep in mind for now. Hopefully that will be something that does pass and they can contain, but again, time will tell. Okay, so those are my overall thoughts on the 2020 stock market, the 2020 economy. Again, hopefully you found some of that useful. If you want to find any more information about us, you can always go to fncadvisor.com. Where we have essentially 3 main categories of our business: personal wealth management, which is where, again, we work with families in their financial plans, managing their investments; institutional retirement plans, where, again, we serve on 401k, 403b, profit sharing plans as the advisor; and then we have our investment strategies, the Chappaqua portfolio strategies, which are a tactical look at a lot of macroeconomic figures to, again, get better returns, hopefully, over time. A lot of cash balance plans use these Chappaqua portfolio strategies, so certainly some great reading material there if you want to check that out. Another resource I'll give to you if you're sort of getting into putting a financial plan together, I've written a book, an ebook that you can go and sign up for. It's called The Ultimate Guide to Becoming a Wealthy Dentist. About 80% of this is really catered to just about anybody could learn from it. But a good amount of this section right here regarding the actual buying and selling of a practice and how that fits into a financial plan will be particularly interesting to a dentist. So the way to access that would be to just go to fncadvisor.com/dentist, or just clicking on that tab. You'll put your email address in there, and then we'll send you both a PDF and a Kindle version. So just a good resource that you might be able to take out of today's webinar. And if you have any questions about anything I've talked about today, or just want to discuss anything more about your personal financial situation, all of our contact information is here. Our blog is here. My LinkedIn is here. And don't be afraid of reaching out. So again, I appreciate everybody joining us today for our outlook on the 2020 stock markets. And hopefully you'll join us for our next webinars as the season goes on.